looking beyond the noise of ongoing geopolitical tensions, if global conditions were to stabilize, will Indian market seize the RBI momentum and break out of the range it's been trading for a long time? Or will it continue to drift on a sideways movement and wait for a new catalyst? RBI has showered a huge bonanza for Indian markets through its repo rate cuts and liquidity boost through CRR cuts. Will Indian markets take it from RBI and run from here? That's a question which is there on top of the mind of many seasoned investors who are basically weighing between this new fillip which has come from RBI and the broader market realities and uncertainties. This is a question we are going to be looking at in this video post. Hi everyone, welcome to our new edition of video post. Like every edition, our objective is to deliver valuable insights in the world of investments and markets. Trust this edition too will be very insightful and engaging for all our viewers. Before that, request you all take a minute and subscribe to our video channel if you are not already subscribed, and that will give us the required motivation to continue to post engaging videos on a regular basis. Now coming back to where we started, will the Indian markets break out of the sideways spell and break out of the range? Can the RBI bonanza do the magic for Indian markets? To understand this, let's look at the two critical engines on which the markets are run. On one side you have the valuation re-rating engine, and the other side you have earnings or earnings upgrade engine. On the first aspect, it has done more than its required due part for more than 2 years. There's not much of a steam left on the first part. Markets have been trading at an expensive multiple and has been trading at a huge premium to historical averages. There's not much of a steam left. If at all, there could be some downward adjustments, but given the robust macro in terms of forex reserves, twin deficits, and resilience in Indian currency, it's very unlikely that market would see a major crack in spite of trading at a very expensive valuation. Now let's look at the second engine, which is the earnings upgrade engine. Is there a case for a huge earnings upgrade? This is where I think the structural issues in the economy creeps in. Unfortunately, the key drivers of the economy have been stuck in a low gear for a long time. They too have been stuck in a range. Be it your private consumption, be it your private investments, or your net exports. All of them have been struggling to break out of the range for a long time. And growing uncertainties in the global economy because of trade war and other geopolitical challenges, it's unlikely to get any better. Can RBI change these drivers through these latest liquidity measures? Very, very unlikely. Of course, it can add at the margin to the consumption boost through liquidity measures and repo rate cuts, but that is very unlikely to change the overall earnings profile for the indices. As a result, we have very interesting and contrasting scenarios on hand. On one hand, robust macro support is there for the markets. As a result, it's very unlikely that market will go through any downward correction. At the same time, on the other hand, there are challenges for earning upgrade because of those stuck economic drivers. It's very unlikely that markets will get a boost from a very sharp earnings upgrade. That is critical for markets to move into the next range, break out of the current range and move into the next leg of bull market. So basically we are stuck in these two contrasting scenarios, which means the markets are unlikely to break out and they're likely to stay in a sideways spell for a long time to come. So how, given the strong visibility in terms of both domestic and FI flows, markets will get the required liquidity boost in terms of making an attempt to get into the next leg of the bull market, but given the lack of visibility on the earnings, it's unlikely to be a sustainable one. Does this mean sideways markets are bad for investors? Absolutely no. Especially for value investing strategies, stock picking strategies, sideways market augurs well because it rewards bottom up stock picking. Unlike the last 2 years of one way market, which was rewarding handsomely momentum strategies. For momentum strategies to come back, it's going to take a while. Until then, one needs to settle for a sideways spell, though it may not be a stagnant one. So interesting time for the markets. Keep watching. It is likely to deliver a lot more opportunities. At the same time, very unlikely that the markets will break out into a new leg of bull market. That's our view from TrustLine House. Thanks for watching. With this, let me conclude this video post. Hope you found this very interesting and insightful. If you like it, please do subscribe to our channel and share this post very generously with your friends and network. That will help us widening our reach. Thanks a lot for watching. Happy value investing and stay tuned to our channel.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.